Hi, this presentation is going to be over the research paper titled Risk Analysis of Bankruptcy in the U.S. Healthcare Industries Based on Financial Ratios, a Machine Learning Analysis. This paper was written by Hadi Ghalampour and Majid Asadi. This presentation was made and is presented by myself, Leslie Keller. Introduction. The correlation between personal bankruptcies and financial distress in the healthcare sector has been tested and proven to be a sound indicator of how our overall economy is trending. Medical debt, as one of the leading causes of individual bankruptcies, tends to have profound effects across both the financial world and the medical world. In addition to costs of medical care, you also have the effect of mass employment and investment opportunities, both of which support the economy in a large degree. All of this shows us that this study, focused on the bankruptcy risk of U.S. medical and healthcare entities, is valid and needed. Next, we'll dive into the study summary. Unique study conditions. This study took place over the course of 2022. This ensured that the study faced unique conditions such as a bear market, which is a prolonged drop in investment prices, record high inflation levels not seen in over 40 years, a high increase in interest rates, and of course, recovery from the COVID-19 pandemic. Overall, this study aims to provide healthcare stakeholders with critical insights to bankruptcy risk in the industry, as well as alert them to possible financial instabilities, and to propose strategies to navigate those risks and instabilities found. Methodology. Collection of the data in this study was taken from the U.S. healthcare stock market via sec.gov. This data was taken from 1,265 companies total, all from their official 2022 financial reports. As part of the methodology, this data was then used to calculate a comprehensive set of 40 financial ratios, including, but not limited to, a debt-to-equity ratio, which gives us indication of the state of the company's leverage structure, operating cash flow ratio, which helps us understand the liquidity situation, the debt ratio, which lends a good view of the debt situation, and the net profit ratio, which helps show us how profitable these companies actually are. This study deployed a machine learning classification approach to help predict bankruptcy using 3 different models. These models were the Altman Z-score, the modified Altman model, and the Olson model. These models have been proven to work in the past and are reliable in use. 8 different machine algorithms were also used to aid in the prediction of bankruptcy. These include, but are not limited to, logic regression and a decision tree. Key findings. All 3 models found that there were lots of high bankruptcy risks in 2022. Why? In 2022, the COVID pandemic, along with escalating inflationary pressures and the 2022 aggressive interest rate hikes, led to a very volatile industry in terms of finances. This volatility led to increased borrowing costs, which affected market valuations and liquidity. Historically, this doesn't bode well in the healthcare sector's favor, as the healthcare sector has proven more sensitive to interest rate changes. After running the analysis and the algorithms, the researchers ended up with 2 very different but very important results. In both the Altman models, the return on investment ratio proved to be the most sensitive and important for predicting bankruptcy in healthcare entities. This ratio compares net income to investment. The analysis and the Altman models found that a low ROI shows that gains on an investment will not be favorable to the company's cost, which indicates future financial distress possibly. In contrast, the Olson model found that the return on assets ratio, or ROA, was the most important ratio in predicting bankruptcy. The return on assets ratio tells us whether a company is efficiently using its assets to generate profit by showing company's profitability relative to the total assets of an entity. If the return on assets is proving unfavorable, It's a strong indicator that the company's finances are not trending in an overall favorable manner and that company might be trending towards bankruptcy. Analysis of key findings and the overall paper. Most important takeaways. There are 4 important takeaways from this study and article. Number 1. The fact that the proven models have found 2 different results indicates the need for a multidimensional approach in future bankruptcy risk assessments. Number 2. There is widespread financial distress in the healthcare sector that is concerning, as indicated by the financial ratios, most prominently by the return on investment ratio and the return on asset ratio. Number 3. As models are only good through 2024, reassessment and monitoring will be needed to ensure solvency, or else there will be significant financial decline ending in bankruptcy for many healthcare entities. This will be detrimental for the entire economy. Number 4. Recent advancement in technology could further boost our understanding of predictors of bankruptcy, helping us to change course in real time to avoid this path. Is the article outdated? The answer is yes. Why? Because 1, despite proving a point that the return on investment and return on asset ratios are great indicators of bankruptcy risk, the models made in the study are only good through 2024. As it is now 2025, the models are no longer relevant and a new assessment is required for more up-to-date data. Number 2. The economy has significantly shifted since this paper was written, and again, a new assessment is needed to reflect that. Number 3. There are similar yet different economic conditions than in 2022. We are no longer technically recovering from the COVID pandemic. Interest rates are still high, but are leveling off finally. Inflation is still happening, but it's uncertain how that trend will go this year. Number 4. Despite only a 3-year difference, the economy shifts in real time and therefore needs the most up-to-date information for solvency to exist. This paper does not have the most up-to-date information. How does this article tie into the content for Lesson 6? Chapter 9 in Kopensky focuses on understanding and calculating current and future values on investments, as well as cash flows and investment returns. This article shows us that a well-done bankruptcy analysis does a couple of things regarding this topic. A. It indicates how well a person at an entity is calculating these values based on how well the entity's cash flows, investments, investment returns, and acquired assets are doing currently. The models used in the assessment help predict how these are going to do over the next few years. B. It highlights that there is a direct connection between knowing how to calculate and leverage these values, directly impacting the bankruptcy risk for an entity and therefore also impacting the overall economy in a large way. Chapter 10 in Kopensky focuses on calculating and understanding financial risk and required return. This article shows us a few things regarding this topic. A. Understanding the level of risk that an entity is undertaking versus the amount of return on an investment directly impacting the bankruptcy risk for an entity. B. The return on investment and return on asset ratios are important figures to pay attention to in regard to knowing your entity's bankruptcy risk. C. That bankruptcy risk in return also impacts financial risk and required return. So knowing how to calculate and balance these is vital. How can I apply what I have learned in this article to on-the-job situations? Well, in a future where you are in a job at a healthcare entity with a hand in the entity finances, you can A. Make sound investment advice with proof to entity executives based off of any financial analysis you have performed. B. Understand which ratios at what levels in a financial analysis would heavily indicate any bankruptcy risk, and understand how to correct the current pathway to avoid bankruptcy. These are my references. Thank you very much for listening.